Welcome back to the Neuro Finance Masterclass. We have officially reached day 80.
Okay, let's jump right into today's explainer. Hitting day 80 is a massive achievement, and today we're tackling a concept that literally separates the amateurs from the financial architects.
It truly is a huge milestone. Over the last few days, we've focused heavily on building out your wealth empire, which culminated in yesterday's perfect asset allocation blueprint. Today, we're shifting gears from construction to preservation. The theme is Portfolio Rebalancing, the art of mechanical maintenance. We're going to look at exactly how you structurally protect the empire you just built.
Section 1. The milestone and the drift, when the market comes alive.
Look, we all love setting up that perfect financial plan, right? But here's the dangerous reality. The market is not static. It breathes, it surges, and it crashes. Think back to that ideal day 79 portfolio blueprint we built yesterday. Perfectly calculated. You've got your exact target percentages, 60% in stocks, 20% in crypto, 10% in gold, and 10% in cash. That is your baseline. It's your financial center of gravity.
But man, how quickly do those clean lines warp in the real world? Imagine your crypto enters a massive bull run. Suddenly, that carefully calculated 20% allocation swells up, it explodes, and now makes up a whopping 50% of your total net worth. Your original blueprint? It's completely distorted.
Exactly. And this brilliantly illustrates what we call portfolio drift. Your once perfectly balanced empire is now heavily skewed, and that leaves you exposed to some extreme concentrated risk. If that one oversized asset crashes, your whole skyscraper could come tumbling down. Leaving this distortion unchecked, it's a structural fatal error.
Section 2. Defining portfolio rebalancing, the counterintuitive fix.
Let's lay down the formal definition here. Rebalancing is the process of bringing your portfolio back to its original geometric blueprint. How do you do that? By intentionally selling a portion of your winning assets, your overperformers, and using that cash to buy more of your underperforming assets. It is a foundational, absolutely elite principle within this masterclass. Now, I know exactly what you're thinking. It's the ultimate amateur question, right? Why would I sell my best performer to buy my worst? It just sounds entirely backward. If my crypto is going to the moon, why on earth would I sell it just to buy stocks that are currently dropping? It kind of feels like you're cutting your flowers to water your weeds.
And you know what? That right there is just emotion talking. Amateurs are driven by fear, greed, and guesswork. They just want to ride that emotional wave forever. But architects, they rely on math. The architect doesn't emotionalize these moves. They recognize that selling high to restore balance is not a penalty. It is pure mathematical genius.
Section 3. Forcing the math, mechanical buying low and selling high.
Let's strip away all the hype for a second and look at the exact mechanics of why this actually works. It all comes down to the absolute golden rule of investing. Buy low, sell high. Literally everyone knows it, yet almost no one actually does it. Why? Well, because when prices are low, people are terrified to buy. And when prices are high, greed takes over and nobody wants to sell. Emotions just always get in the way. So the really crucial point here is that rebalancing forces you to execute this golden rule mechanically. Step 1, you sell the asset that's pumped, meaning you are systematically locking in top profits, just like we discussed back on day 74. Step 2, you take those profits and you buy the dip on the underperforming asset, snatching it up at a steep day 69 discount. In step 3, you seamlessly restore your original blueprint. This whole concept is so incredibly freeing as an investor. The math does the work. You don't need to guess where the market is going next. You completely remove that stressful need for market prediction. You just let the mechanics do all the heavy lifting.
Section 4. The architect's schedule, unemotional execution.
So when and how often should this mechanical maintenance actually happen? First off, a massive urgent warning for you. Do not rebalance every single day. Seriously. If you try to obsessively tweak your portfolio every 24 hours just to maintain perfect percentages, you are going to get absolutely destroyed in transaction fees, and it's going to completely ruin your neurofitness. Precisely. An architect operates on a strict, highly authoritative, unemotional schedule. You essentially have two elite rules of engagement to choose from here. Option 1 is time-based. You rebalance once every 6 months, or maybe once a year. Option 2 is the threshold trigger. You only execute a rebalance when an asset drifts more than 5% away from its target weight. And the true beauty of this is, when that trigger hits, whether it's the date on the calendar or hitting that 5% deviation,
You just become a machine. You don't go check the financial news, you don't listen to the hype, you simply look at the percentages, execute the trades, and restore balance to your empire.
Section 5. Your maintenance plan. The cognitive task.
I want you to keep this really powerful metaphor in mind. A skyscraper doesn't stay upright by accident. It requires maintenance. Preserving the immense wealth you're building in this masterclass requires active, mechanical engineering.
All right, so here are the exact strategic steps for today's assignment. First, go look at the Day 79 asset blueprint you created yesterday. Second, compare it to your actual holdings right now. And third, write down your chosen strategy. Are you going time-based or threshold-based? Keep your ratios clean, keep your mind clear, and just trust the machine.
We're going to leave you with this provocative question to audit your portfolio today. How far has your empire drifted?
Thanks so much for joining us for this explainer, and we will see you right back here tomorrow for Day 81.